Gold experienced one of its most volatile sessions of the year after a historic shock in U.S. labor market data. The Bureau of Labor Statistics revealed that nearly 1 million jobs were overcounted in prior reports, making this the largest downward revision in history. The employment benchmark for March 2025 was reduced by 911,000 jobs. To put that in perspective, that is roughly 3 times worse than the average revision over the last decade. Analysts said the discrepancy stemmed from flawed business reporting and low survey participation. But regardless of the cause, the surprise revision rattled financial markets across the board. Gold prices spiked immediately, surging to a record $3,674.69 per ounce as traders rushed into safe haven assets. But the rally was short-lived. Prices pulled back quickly, reflecting uncertainty about how deep the labor weakness might run. Still, gold finished the day slightly higher, supported by expectations that the Federal Reserve will be forced into rate cuts sooner rather than later. Technical momentum remains firmly bullish. Traders are watching resistance near $3,750 and support at $3,650. Holding above that support level keeps the breakout intact. Many believe that if resistance is broken, gold could begin targeting the $4,000 level before year's end. Silver also looks strong, trading near $40.81. A bullish flag pattern has formed on the charts, which often signals continuation to the upside. Many analysts are targeting $45 as the next level for silver if the current momentum continues. The macro backdrop continues to play into gold's favor. A weakening US dollar, steady gains in the Chinese yuan, and political uncertainty in Europe, particularly in France, are all fueling safe haven demand. At the same time, central banks across emerging markets continue their steady gold purchases, reinforcing the long-term structural bid for precious metals. Meanwhile, traders are now pricing in an extremely high probability of a Federal Reserve rate cut at the upcoming meeting. Some are even speculating on the possibility of a larger, more aggressive cut if labor market weakness persists. This is critical because rate cuts lower the opportunity cost of holding gold. As Treasury yields move down and the dollar softens, gold tends to shine brightest. That dynamic is already visible. While yields held steady today, futures markets are signaling strong expectations for easing throughout the remainder of 2025. Elsewhere in commodities, oil prices climbed modestly, supported by supply constraints and a softer dollar. U.S. stock futures pointed to slight gains, but equity markets remain cautious as stagflation fears begin to creep into the conversation. Investors are now turning their attention to the upcoming inflation data, which could determine whether the narrative shifts toward stagflation, a combination of slowing growth and sticky inflation that would be challenging for both equities and bonds. In summary, this unprecedented labor market revision, nearly 1 million jobs erased from the books, is a watershed moment. It highlights just how fragile the U.S. economy may be beneath the surface. For gold, the reaction was immediate. A spike to record highs, a pullback, and a continued bullish outlook as traders brace for Federal Reserve policy shifts. Key levels remain clear, support at $3,650, resistance at $3,750, and an eye toward $4,000 as a potential next milestone. As long as labor markets weaken and monetary policy eases, the broader trend for gold and silver remains up. Volatility is high, but momentum is still on the side of the bulls.